just a correction, or is the next big stock market crash finally here? What do you guys think about this? So the Dow, in case you guys have not been paying attention, the Dow has been falling for about a week now, but today it plunged nearly 800 points, was down more than 1,500 at one point. The Dow also broke below 25,000. It closed, looking at my screen right now, I believe it just closed below 25,000 too. Today is Monday, February 5th, 2018, almost 4:15 p.m. Eastern Time. And the S&P 500 traded down more than 5% from record set last month. So obviously a lot of the talking heads on TV are saying, the market was overdue for a halfway decent correction. We hadn't really had a 3% or more correction in over a calendar year. I think it was over 400 days. And so it'll be interesting to see if this really is the next big crash, as people are predicting. But what has stopped crashes in the past, really for 10 years now, has been intervention by all the different plunge protection teams that are involved with the Federal Reserve, with the Treasury Department, with the federal government here in the United States. And so whether that's the Exchange Stabilization Fund, or ESF as people call it, or the 3 or 4 other President's Working Group on Financial Markets, there's a number of different plunge protection teams. Supposedly one of them is just academic that Dr. Pippa Malmgren worked on, but there's a number of them that are intervening. We also know that the New York Federal Reserve has a very large trading desk and that central banks get huge discounts on trading volume. I think one of the most popular ways to manipulate markets for a long time now, really for 10 years, has been that S&P 500 E-mini futures contract. And so in the past, when markets were having corrections similar to this is the Dow Jones Industrial Average chart, the 1-year chart. And so this was going steadily up a lot with very little, if any at all, corrections, really not even a 1% correction for over 140 days. And so finally we've had a correction here. Take a look though at the year to date. So, we've started to get violent here with the volatility. The 1 year, like I said, here's the falling off a cliff here, and then a strong bounce back probably with market intervention with plunge protection team. So I don't know if you can say for sure we're going to crash because of all the manipulations and interventions. There's a lot of manipulations and interventions. There's, for years now, like I said, about 10 years now, there's been, whenever the technicals and the high-frequency trading algorithms lately have been about to turn and become very, very bearish, and a small correction of 3% or more is about to turn into potentially a crash, what has happened is that towards market close, say around after 2 p.m., between 3 p.m. and 4 p.m., sometimes even after the market closes in the aftermarket hours, you have just enormous buying of S&P 500 E-mini futures contracts, sometimes even $20 million or more. In years past, a couple years ago, there was $20 million, there was over $10 million, sometimes as high as $20 million bought in S&P 500 on the long side. And so these are basically not-for-profit people just coming in large purchase orders. And so a lot of the traders I talked to thought that that was a clear sign of market manipulation. Whichever group that was potentially a plunge protection team would come in and buy. Maybe it was the New York Fed, maybe it was the Treasury Department, maybe it was one of those other groups I mentioned. So what are your thoughts on this? But one of the other things I wanted to bring to attention really quick in this short video was the VIX. So this is the max VIX chart. Normally in the past we had a lot more volatility. Lately, basically since the 2008 financial crisis, and we know with the Federal Reserve minutes and who's going to be current Federal Reserve Chairman Jerome J. Powell, this came out recently in the 2012 transcripts. They released them at least 5 years later. So this only recently came out that the Federal Reserve was the original market manipulator for shorting volatility. And so everyone has piggybacked that. This has become an enormously overcrowded trade. And probably the Federal Reserve's been doing this long before 2012, but probably, in my opinion, started pretty soon after the 2008 financial crash to help get things going and get the asset prices going higher. And I've talked about the wealth effect and why the governments need it. Ultimately, it's about government tax revenues. And that's why they don't want the asset prices staying low for a long time. It's not all the reasons that the Keynesian economists come out and say for the positive things about the wealth effect. The main reason is for government tax revenues. During the 2008 financial crisis, there was a huge drop-off in that. And so this is the VIX. This is the max chart of the VIX. And so the VIX had been down. I've done videos on this. I did a video about Christopher Cole of Artemis Capital, who specialized in researching this, and how the VIX had basically become, after central banks, especially the Federal Reserve, had started manipulating, doing shorting the VIX, doing short straddles on all the major stock indices. A lot of Wall Street and people in finance, whether it's day traders or hedge fund managers or investment banks or even pension fund managers, who, by the way, guys, would not put, especially pension fund managers, and from what I've heard from sources, would not put a penny of their own capital into this trade. They were doing it for clients. Very, very dangerous, just to make money. Really dangerous trade. High risk, low reward, just for an income, to try to squeeze out profits, like picking quarters off a freeway during rush hour. Anyways, though, the VIX had been going down for a while. There had been very few large spikes in the VIX, and the price of the VIX had been going lower and lower and lower to basically all-time lows, where it was around 10 or lower for a long time. And finally, you know, in the last really week, the VIX has spiked. And the last few days, the VIX has gone up basically vertical. As you can see on this max chart, it's gone up to over 30, which is a big warning sign. Let me pull up the year-to-date chart on the VIX. So the VIX was basically flat. See, look at this here. The VIX is flat, really below 11-ish here for a long time. Then it goes a little bit above 11, hammered back down. That was clearly the overhead resistance level. And then towards the end of January, it just started to break out. And finally, you know, here's a big, huge upward move, and then probably manipulation back down, or people taking profits, maybe a combination of those two, and a spike back up. So if the VIX stays this high, this will be a warning signal, but we are not in free markets, okay? So just because the VIX is spiking does not mean that the central banks can't come in with fiat money, digital debt-based fiat money, basically unlimited, because there is no independent audits of these central banks, and they can create nearly unlimited money and credit. They've created tens of trillions in money and credit since the 2008 financial crisis. And so really there's nothing right now to stop the Treasury or the Federal Reserve or any of these plunge protection teams from going in there if they want to tomorrow or the next day, maybe for days in a row, and spending 10 million a day, 20 million a day, maybe even more than that, and going and trying to buy S&P 500 E-minis futures contracts, or continuing to try to pile onto that leverage short volatility trade to try to knock the VIX and the volatility in the major stock indices back down. But remember, guys, I have said this for months now, so I knew that it was not sustainable. Look at this let's pull up the 1-year chart of the VIX. So there was very few spikes here on the VIX, and it had gotten knocked back down. Very few spikes, got knocked back down. Finally, volatility started to break out. So this was unsustainable here. These tiny little spikes get knocked back down. This is normally not how markets behave. And I put the main blame, capitalism should not be blamed for this. The main blame for all of this, with the asset prices getting out of control and divorced from reality and manipulating volatility, trying to stop volatility, belongs 100% nearly at the foot of the central bankers, who have made things worse. They've made the rich richer, who have had access to this easy money and credit, and gone in and bought up these asset prices and gotten even richer. And this is, hurt Main Street. So we'll see what happens going forward, but just provide feedback if you think that this is just a normal correction, if the plunge protection team will come in and start to figure out how to manipulate markets. But the high frequency trading algorithms, guys, if the support levels start to falter even more, the high frequency trading algorithms can turn on this and create a very big correction and turn it into potentially crash very quickly. And we know that the plunge protection team and the other people involved in manipulating markets are well aware of this. They probably even use high frequency trading algorithms themselves. We know that they use it actually in the gold market. So we don't know all the different markets they use it, but we know that they've used it for markets like the gold market, with coming in at 2 or 3 a.m. in illiquid trading hours and dumping a whole bunch of not-for-profit paper gold futures contracts on the market, sometimes, over $1 billion worth of contracts, pretty routinely. So I just want to show a couple more charts. Okay, so this is year-to-date now. It's given back, looks like a lot of its gains. It's fallen off a cliff. But this is just year to date. Obviously, long term, it's still in an uptrend. So the point I wanted to make also is that in the long term, especially when you look at the Dow, so the Dow is still in a long term uptrend. Oh, okay, that's the chart I wanted to show right here, the max chart. So this is still a lot of it's because of fiat money and market interventions. But the Dow still, basically since 2009, things, look guys, that's like a perfect upturn line there. And now it's gone parabolic. So it was long overdue for a correction. But the things I would watch for if this really is a crash and not a correction, number one, the gold price hasn't crashed. The gold price is actually holding up pretty decently, so it didn't crash along with a lot of the other things today. The other things are the VIX. So we'll see what happens to the VIX going forward. The VIX, we'll see if they can manipulate the VIX back down. The VIX had an enormous move in the last couple days. And the last thing here that you should pay attention to is the small caps. So if there really is going to be, this really is the next big stock market crash, then the small caps, the Russell 2000, will probably signal first before the Dow or the S&P 500. So I would pay attention to the Russell 2000 and whether or not that actually starts to crash, because during a crash, guys, normally the smaller companies, the more illiquid assets like small caps, those things tend to get sold off first. And people tend to retreat into cash and treasuries and gold and maybe larger cap dividend stocks, some of the safer plays. So we'll see what has to happen. Just provide feedback, though, if you think this is only a minor correction, if you think the plunge protection teams are going to come in here and manipulate things back higher, because that's been the case really for 10 years now, basically, where anytime there's been a 3 to 5% correction, where even 2012, 2013, I remember talking with a lot of market experts, and they thought there could have been a crash then, and we just have these enormous futures contracts, S&P 500 E-minis, futures orders come in and bought, and so things would bounce right off support levels, whereas they would have looked like they were going to maybe break support levels and potentially crash, and they'd magically just bounce right off because there'd be huge buying orders coming in. Let me know what you guys think, and this week, the other guests, as of right now, we're going to have former hedge fund manager and author of the Silver Manifesto, Chris Marchese, come back on. He's also a senior analyst at the Morgan Report for David Morgan. I think, a lot of people who criticize David Morgan have never subscribed to his paid newsletter. He's actually had a lot of winning stock picks. So we're going to talk about how David Morgan and Chris Marchese have picked out a lot of winning stocks during this bear market in gold and silver, despite the gold price and silver price not doing very much. Okay, guys, that's it for right now. Bye. Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS.